Welcome to the 3 Edge Week in Review for the week of March 8th, 2021. I'm Fritz Folts, Chief Investment Strategist here at 3 Edge, and joined here once again today by Steve Cucchiaro, President and Chief Investment Officer at 3 Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing a narrative around the potential for a regime shift within the ecosystem that is the global capital markets. But first, let's just take a look at what happened in the markets this week. On Thursday of this week, S&P 500 reached yet another all-time high. President Biden signed the $1.9 trillion coronavirus relief package into law, and the rollout of coronavirus vaccines in the U.S. continues to ramp out. Now, what is interesting about the equity markets in the recent past is that they seem to be paying very close attention to interest rates, bond yields, and even ongoing treasury auctions. And in particular, investors are watching the yield on the 10-year U.S. Treasury note in the belief that above a certain yield, equities would start to be considered expensive versus interest rates on a risk premium basis. Currently, that yield is somewhere around the 1.60% level. So let's move on to our topic for today. And Steve, clearly, a foundational belief here at 3Edge is the idea that the global capital markets are an example of a complex system of interrelated variables. And today we're going to examine the possibility that there are some important shifts going on right now in the global capital markets, which speak to this concept of the interconnectedness of the markets. And they may have important impact on markets going forward. So why don't we start and lay out this narrative and begin with what could be a very important shift. And this would be a shift from a focus on monetary policy to a focus on fiscal stimulus. And what could that mean, or what might we expect from such a shift from monetary to fiscal stimulus?
Well, Fritz, this is a very significant sea change in the way stimulus is being offered into the economy. Going back to the financial crisis of 2008, every time the economy or the markets had trouble, the burden really fell largely on the Federal Reserve Board, we call the Fed, to try to rescue the economy or the markets. And they have powerful tools. They can lower interest rates to try to create stimulus. They can print money and increase the size of their balance sheets, and then use that printed money to lend or to buy bonds of the government and more recently corporations. And this has a very powerful effect. The only problem is that it's a blunt instrument, and it's a great way to rescue the markets, but not such a great direct way to help the people who were most hurt by the recession or unemployment or the pandemic, et cetera. So they've been crying out. They want to pass the baton to the government. The Fed doesn't have the authority to spend. They can only lend. The government can spend. And now, just this week, we passed in the US the most massive fiscal stimulus plan one could imagine, $1.9 trillion of money that's going directly into the real economy, directly into the hands of people, of schools, hospitals, state and local governments, businesses who need help, much more directly into the real economy than the market economy. And this has the potential to cause a regime shift. And by regime shift, what I mean is something that just happens once in a great while that changes the rules of the game. That for the financial system, you could say that investments and ideas that worked before the regime shift are unlikely to be the same ones that work after.
So, that being the case, that we could be seeing this regime shift, that would mean that there are implications there. And so, what are some of the implications that we may see as a direct result of this shift?
So, one very important one has to do with inflation. Up until now, while the Federal Reserve Board has been causing all kinds of stimulus and dropping interest rates to record lows and printing lots of money, et cetera, because a lot of that money stayed in the financial system, the kind of inflation that it created was what we call asset price inflation. It helped make stock prices and bond prices go up, but didn't do much in the real economy in terms of consumer inflation. Now, with money going directly into the hands of the people in the real economy, we now have the prospect of consumer inflation picking up in a way that we haven't seen in quite some time. Secondly, we have a shift in policy, government policy, where prior we had what you might call capital-friendly policies. We had tax policies. We had a tax cut in 2017 that lowered corporate gain tax gains. We had antitrust rules that were quite lenient. We had deregulation. All of these were very friendly to corporations and to capital. Now there's much more discussion about labor-friendly policies, new regulations to try to make it easier for labor unions to form and organize, the chance for minimum wages to go up, money more directly in the hands of people who need it most. So the shift from capital to labor. Now, we put this all together. You could summarize by saying policies that you could say favored Wall Street or the stock market.
Right.
Now, they're transitioning to policies that favor the real economy or Main Street.
Very good. So, keeping in line with this idea of the interconnectedness, if we see this shift from policies that would maybe be more helpful to Wall Street to policies that may be more helpful to Main Street, what would be some specific examples of those implications of that shift?
So one that comes to mind is in the stock market itself. Before this regime shift, companies, especially high growth corporations, like companies you find in the NASDAQ index, high tech companies, companies that have the promise of making great profits way off in the future, have really benefited from the low interest rates, because when you calculate what a company is worth, you take that earning stream that goes way out into the future, and then you discount it because there's time value of money. You discount it with some interest rate. And when the interest rate's very low, it's a way of saying that you place a lot of value on those profits that might not come for many years, but they're out there. When interest rates go up, all of a sudden your discount rate goes up. You now count at a lower degree those profits that are way off in the future, and you put more credence on profits that are closer at hand. So we could see a shift from companies that were benefiting from low interest rates, like high-tech companies and NASDAQ companies, over to what you call value equities, which are equities that are much more tied to the real economy. And as the real economy grows, their fortunes grow with it. And then secondly, bonds do very well when interest rates come down, because when you buy a bond, you're effectively locking in a higher interest rate, only to see the principal value of the bond appreciate as interest rates come down. That's been the way it's been for 40 years. Interest rates peaked in 1981. 40 years later, they're now at record lows. We think that there's much less room for any more declines in interest rates. There's certainly a lot more room for increases. So this could be bad for fixed income instruments like bonds. And yet the same environment that's bad for bonds is great for real assets, commodities who do well when the real economy grows, and the possibility of gold, especially if with all the debt levels, forced to print more money.
Right. Well, great. You know, I love this narrative. I think it's very instructive, and it expresses how critically important it is to really understand the degree to which events do not occur in isolation in the ecosystem that's the global capital markets. And I think that this could well be an important investment narrative for years to come. So thank you for laying that out for us here today. So that will do it for Steve and me. We will be back next week with another edition of the 3Edge Week in Review. All of our videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. You'll have a special place in our hearts at 3Edge if you'd be so kind as to subscribe to our 3Edge YouTube channel. And if you'd like to submit any questions or make suggestions for future topics, we'd like to hear from you. And you can just write to us at WeekInReview, all one word, WeekInReview at 3edgeam.com. So now, on behalf of everyone here at 3Edge Asset Management, we urge everyone to stay safe and be well. And thank you very much for listening.